So let me very quickly go back to the page that I left you with. At close of trading yesterday. I'm going to call it close of trading, right? See, one of the problems with everything you do between 4 and 5 is that it kind of fades into this haze. You're not quite sure it happened, but it did happen. We did talk about equity risk premiums, and we did end with this page of equity risk premiums by country. There are 145 countries that I had equity risk premiums from November of 2013. And what I left you with is the reason I need this entire page, no matter where I go in the world, is because a company's risk doesn't come from where it's incorporated and traded, it comes from where it does business. I mean, I've never understood why this even evokes debate. It's amazing how often I run into people who say, no, it's an Indian company, it has to have the Indian equity risk premium. So it doesn't make any sense to me. It has to come from where you do business. So let me take my companies and work through how I came up with the equity risk premiums for my companies. Right? Let me start with this. US company, right? I went to look to see where it did business. And let's face it, you are constrained by the information companies give you. You can't go ask them, where do you do business? Because they're not going to tell you. And in their financial statements, this is how Disney breaks down their revenues. Say, why are you just looking at revenues? Why am I looking just at revenues? First, in most companies, that's all I can get. Second is, there are some companies that will break down EBITDA or operating income by region. I would not trust those numbers further than I can throw them. Because I know the accounting considerations, the tax considerations will drive where you tell me you make money. So I take revenues because it's there, and it's always a positive number. You see the other advantage of that? Your weights will always work out. So 82% of Disney's revenues come from the US. 11.6% from Europe, 6% from Asia, 0.33% from Latin America. Make sure your weights add up to 100%. That's the only constraint I'm going to put on you. I have the equity risk premium by region. So let me go back to the previous page and explain a little bit about how I get these regional equity risk premiums. You take Asia. You see an equity risk premium of 7.27%? That is a weighted average of the equity risk premiums of the countries. Weighted in what sense? Well, China has a much bigger weight than Vietnam. Because if I just take a simple average, I'm throwing Cambodia into the mix with China and treating them as the same. It's a GDP weighted average. I get the GDPs from the World Bank, I take the weighted average, so I have the equity risk premium by region. So that's what you see as the equity risk premium by region. So the weighted average of those equity risk premiums is the equity risk premium we're going to see for Disney from this point on. In fact, let me add one more point. This is based on their existing geographical exposure, right? Let's assume that you learned that Disney is planning a massive expansion to Latin America with ESPN Latin America. What would you need to do if you're analyzing Disney as a company and valuing the company? What would you need to do? Today's equity risk premium is 5.76%, but as you go through time, if you're giving them the growth of investing and expanding to Latin America, you also have to give them the consequences of investing in Latin America, which is the weight on Latin America is going to increase and the equity risk premium is going to go up. This is what I found troubling about the last 15 years of the emerging market siren, right? So the companies, what do they say? Well, we're going to grow in emerging markets. And he said, congratulations, good, we're going to push up your value. But that comes with a mixed blessing, right? You get the higher growth in emerging markets, but you also get the higher risk. Maybe that risk is catching up with all those companies that sought out the China growth story. There is always another shoe waiting to drop. And your job and my job is to not wait till it drops and say, oh my God, it happened, but to try to bring in whatever we can into the process. Question?
Like in the case of Europe and Asia Pacific, won't we average out the countries they are in? Like, for example, Asia Pacific.
In fact, let me back up. Why did I break the revenues down just by region? Why didn't I break it down by country?
Information.
You have to live with what you have. Be happy that they at least broke it down the way they did. Most US companies, you know how they break the revenues down? 81% of our revenues are in the US, 19% is in the rest of the world. Come on, guys, that's a really big place. Can't you start getting more specific? So the reality is, if you had individual countries, you could break them down.
Europe, you know, it's only Paris.
No, you don't know a thing about Europe. You're thinking the theme parks are a very small slice of Disney's revenues. They're tiny. It's broadcasting, it's ESPN. So don't jump to conclusions about where the revenues are coming from unless you have a much more specific breakdown. So work with what you have. And some companies are good about In fact, if I were writing the accounting rules, this is the kind of thing I want more disclosure on. Because as we become global companies, I need to know not only where you get your revenues, I'd like to know where your factories are. If I'm Bellingham Broward, I need to know what contracts you've entered into, what airlines you've contracted with, because otherwise, how the heck am I going to value Broward? So revenue weights, equity risk premium for the company. Now let's finish the rest of the story. I have 4 more companies. Let me do those. I took Vale. It's a Brazilian company, right? Really? It's a Brazilian company? Why? If you look at where its revenues come from, you have 37% of the revenues come from Vale. Vale is just another China story, and no wonder its stock price is down to $2 from $15 a year and a half ago. It's being slaughtered on 2 fronts. It's a Chinese company and it's a commodity company.
Yeah. Well, this is a Brazilian.
I call this the 3C. And you got the country and the currency. So you got the 4 C's all kicking in against you. You're in a risky country with a currency that's imploding in a commodity business, and you get the bulk. You could not devise a more hellish scenario to be in. And the reason I say that is the CFO of Vale is actually an old student of mine from 15 years ago. He graduated from my class. So last year when I was in Brazil, I was valuing Vale, and I was talking about this scenario unfolding, and he emailed me before I came to Brazil and said, could you tone it down a little bit? Could you make it a little more optimistic? I said, look, I don't have the power to write happy endings to the story.
No, in this case, there is another C, which is a catastrophe.
Okay, 4 C's will already tip you over. The 4 C's coming together is the catastrophe, right? So catastrophe is the end product of 4 C's, exposure.
So there is a dam that broke.
That's right, the 5th one, which is now you've got, that problem.
Yeah.
Maybe they're just, in India, you often, if you look at when people start businesses, the moon has to be aligned, the stars have to be aligned. It's amazing, 9:23. If I don't open the business at 9:23, not for another 2 years. Right? Maybe there's something to this whole thing. Maybe there's some doomsday scenario that unfolded because you pissed off the gods somewhere along the way. Right? My equity risk premium for Vale is a weighted average. And you can see it's a mix of some they've given me countries, some they've given me regions. I work with what I have. Yeah.
But how do you estimate the regions?
They actually give it to you. So you ask me, how do I get the regional premiums? I take the GDP weighted average of the equity risk premiums. So in a sense, I'm saying if you're in Asia, and that's all you tell me, I'm going to assume that you're actually getting more of your revenues in China and India unless you tell me differently. I could be wrong because you could be one of those companies that gets all of your revenues in Cambodia. God help me if that is the case. But that, unless you break it down, so that's what I meant about working with what I have. Yeah.
Rest of the world, how do we get the ERP for rest of the world?
Well, you just where you got the ERP for, you take the weight. It's an Excel spreadsheet. It's not like you're sitting down multiple. So basically all you need to do is set the GDP for the US to 0. I have a GDP weighted for the entire globe. Just set the GDP of whichever country you want out of the mix to 0. And the Excel spreadsheet recomputes the weights. So it's not difficult to do. It's tedious. I wish I did not have to do the rest of the world stuff. But again, it's something I've had to do every time I value a company. Yes?
Just one question on the detail of this, just conceptually. It has business in all these countries.
It's revenues in all these countries. Yeah.
But in the end, it consolidates back to the Brazilian company.
Okay.
Do you see any risk because there's a kind of...
I'll tell you the bigger risk. It has revenues in all these countries, but if its mines are all in Brazil, then we have an issue. So by having a revenue focus, I am missing the fact that there is an operating production focus. So if I had the information, and I did look for the information on volume, if I had the information on where you produce stuff, maybe I will weight both the revenues and the operations. This is a flexible approach. With natural resource companies, I don't look at where your revenues are. If you're a Nigerian oil company, I don't care if 91% of your revenues come from the global oil market. You are stuck in Nigeria. Guess what? I'm going to give you the full force of Nigerian country risk. There my tilt is towards production and reserves. So that's, I think, a decision you have to make on a company by company basis as to whether you want to bring in the operating side. And the constraint you're going to run into is companies are not very forthcoming about giving you information on that. Now, Bookscape, I got lucky. Bookstore in New York City, presumably they're not, unless they have, this is how things can get tricky, unless they have an online and they're selling only to the Chinese. That's their own version of a China story. Luckily they did not. So basically 100% in the US. Tata Motors, broken down. In 2013, they got 23.6. That percentage the following year jumped to 38%. China is now 38. I have no idea what Chinese are doing in these gigantic Land Rovers, but they seem to love them. Jaguar Land Rover, it's a big business. So weighted average across the regions of the world, 7.19%. Baidu, I've never talked to anybody who's used the Baidu search engine who hasn't lived in China. That's both good news and bad news. Good news for me because it means that when I do equity risk premiums, I can just be China focused. Bad news for the company per se because it is connected completely to the China story. And finally for Deutsche, they do break down that with banks it's kind of tricky what revenues are. They break down their, basically their assets by region of the world. So the risk-adjusted asset, which is basically the loans, all the stuff. So that's the breakdown for Deutsche. 36% in Germany, 25% in North America, 29% in the rest of Europe. And please God, let it not all be in Greece. But that's all they tell me, rest of Europe. So I've got to take it on face value. Asia Pacific, South America. It's actually very close to zero. So you see, why do you even throw? So it was like 0.001%. Yeah.
Would an internet multinational follow the same logic, stating with software developers in California,
That's right.
marketing team in Ireland,
And you have an issue, and that's why
the entire planet as a source?
That's exactly right. In fact, did everybody get his point? If you are Microsoft, when you use Office, where do you think all that software is written? Probably written in Bangalore, India, right? It's probably processed through an Irish sub and it's sold globally. So again, it means that we have to start thinking about this. So and the reason I've kind of stayed with revenues is not because I want to stay only with revenues. It's because the information on that other stuff is still not forthcoming. But I think that is what we should be pushing companies to reveal more of, because I need to know that. I need to know that your software developers are all in India, even though your revenues might be all in the US, because it affects the way I think about risk and value that I attach to you as a company. So let's update. So that was November of 2013. We're in January 2016. So let me take you through the process of how I'm going to update my map. I want to start off with a mature market premium. Remind me again how I did that in November of 2013. I took the S&P 500. I did an implied premium. Then I made a leap of faith. I said, the S&P 500's premium is roughly speaking the premium that I'm going to use as a mature market. I don't know whether you remember, but at the start of 2016, the implied equity risk premium I came up with for the S&P 500 was 6.12%. I could use that as my mature market premium. But it strikes me as hubris to have a second decimal point on a number that is really an estimate. Right? It will give this precision. Again, I could say 6.12. People will be impressed. Oh God, he's got the 6.12% nailed down. But the reality is roughly 6%. So when you see the 6%, in fact, somebody emailed me from KPMG London yesterday saying, how come the 6.12 became 6? Rounding down to the nearest number that you could use 6.1. It's not going to change the world. So the 6% base premium you're going to see is going to be the premium that I got for the US. That number is going to populate the entire spreadsheet. Wherever I see a AAA country, I'm going to put a 6% premium on it. You see my logic for doing that? If I gave you 5 mature markets and I told you the equity risk premium for the first market is 6, the second is 4, the third is 8, the fourth is 5, and the fifth is 15. What's the problem with that? They're all mature markets, and one market is delivering a 15% premium and the other is delivering a 5% premium. As an investor, what are you going to do? You're going to pull your money out of the low premium market and shift it to the high premium market. It's internally illogical to claim that you have 10 mature markets with different premiums in them if they're truly mature. So that's why, so if you don't like my using the S&P 500 as a base, use something else. I don't care. The MSCI Developed Market Index, something like that. It doesn't matter. You want a starting point, that becomes a starting point. Yes, sir. I don't have. I can tell you exactly what it is, because where does the standard deviation come from? What are all the numbers I'm uncertain about? The growth rate. The growth rate. I would say plus or minus 20 basis points. Right? But the biggest number that's driving this is that buyback, the 106 dividends plus buyback. If you get a chance, I posted, the very first post I made this year was entirely about the implied equity risk premium. And I stress tested, what if this, what if that, what if this and that. In fact, so take a look at it, because I look at how much range there can be around it. But I feel pretty confident that this number is not a 3, it's not an 8. It could be a 5.5, it could be a 6.5. I can live with that. Right? So that's the 6% base. And remember again how I got the risk premiums for other countries. Once I got the base, then I said, tell me what your rating is. AA, okay, I'll find the default spread based on your rating, or use a CDS spread. And then I'm going to scale that spread up for the higher risk of equities. And I do this for every country for which I'm able to get either a CDS spread or a rating. So here's what the world looks like. Start of 2006, January, let me not even say start, that's too fuzzy. On January 1st, 2016, the world looked like this to me. So pick any part of the world that you're familiar with, take a look at how different the numbers are. Let's take Latin America. Brazil is now at a 9.28% equity risk premium. That's assuming that the rating-based spread is right. If I go to the CDS spread, Brazil's at 11, 12, 13% probably. Right? Across Latin America, no surprises. Thank God you're not investing in Belize, or Argentina, or Venezuela. Let me take that back. If you're investing in Belize, Argentina, Venezuela, make sure you demand a really high rate of return. Gabriella was just talking to me before the class started. She is pushing a business in Venezuela. And if she makes a 35% return, she's probably just breaking even. Say, that's so greedy. It's not. You're investing in Venezuela. You better make a 35% return. Otherwise, you're getting drubbed for no reason at all. So that's one of my worries when people lump regions together. Is they act like every country in the region is equally risky. You look at Latin America. Chile is very different from Venezuela. So if you're investing in Latin America, I need to know where before I make the judgment. John?
The fascinating thing is that you've compared the start of January to today.
Yeah.
And I think that it's worth everybody thinking about how risky a stock market looks when it's at the lows and how safe it looks when it's at the highs, which is the flaw in a lot of the risk-weighted models that we look at.
And I think that's, in fact, I'm going to do an update of this at the end of January. I usually avoid updating to the middle of the year. But when you have an eventful month like this one, it's time to revisit. And that's why I printed off the CDS spreads as of yesterday. So you can see which countries people perceive to have shifted in risk the most over a 2-week period. And whether you want to use a normalized value, which is basically what you're saying, the risk weighting.
No, what I'm saying is all risk metrics will show you that any asset is very risky when it's very cheap. So you have to work very closely with valuation.
But be careful. When you say very cheap, most assets that are cheap for a reason.
Well, let's take the bottom. If you took the stock market through time, every time it's at a low point,
no, but
all of these
that's a
will show
very,
high.
very dangerous pathway to take, right? Because you're assuming that every bottom is followed by what? A recovery. That's the old it's really the allure of historical returns, right? You can say, over time, we've gone to a bottom and we've always come back. I agree with you 90% of the time, except when it doesn't happen, right? There are times when you don't come back. And that is the catastrophic risk in equities. That's why if we always come back from lows, Let's say that's always the proposition. You always bounce back. Equities over very long time periods become almost riskless, right? In fact, there are people who argue, if you take a 30 or 40-year time horizon in the US, you will never lose money. Jeremy Siegel, stocks for the long run. He says, oh, you'll always, it's just absurd. Because if you invest in the Nikkei in 1989, you are not making your money back in this lifetime or the next 5. You're done. That's the catastrophic risk.
That's exactly my point. In 1989, the
Right.
Nikkei would have looked like a very riskless asset.
Right.
On every risk measure, the Nikkei in 1989, when it was at its top, would have looked
But that's with an implied,
very
but-
riskless.
Right.
And equities in Q1 2009 would have shown up as the most risky assets, and you wouldn't have bought them.
I agree with you. That's what the implied premium captures. And the question is, the asset allocation states that's what you do, right? You look at a premium and you say that number is too low, which means you're going to be pushing money out of Japan in 1989 into a market that delivers a much better pay offering. So one of the reasons I do implied premiums from an asset allocation standpoint is I want to look at this map and I want to look at the actual implied premium and say, this market doesn't look right. The implied premium is 3 times higher than I'd expect it to be. So think of this as my intrinsic premium map, and then I'm going to do the implied premium for these countries to see if in fact they're cheap or expensive given what I need to make. Yes?
The top right corner of
Okay, so that wasn't in the previous graph, right? There were about 17 countries, or actually 22 countries in November of 2013 where I wasn't able to compute an equity risk premium. You're saying, how come? What do I need to compute an equity risk premium for a country? I need a rating or a CDS spread. There are countries that have neither. Like what? Syria, Afghanistan, Iraq. These are called frontier markets. Basically, they're markets that, you ask me, are they risky? Come on, you don't even have to ask that question. But people have given up. They basically don't, they say these markets are too unsettled. And for as long as I've done these, I've kind of ignored those markets. But I get enough emails, you'll be amazed that there are actually Syrian business people who are making investment decisions and they say, what's a hurdle rate for me? And the only response I give is a really high number. And that doesn't help them. So I decided I would try to actually come up with these premiums for these markets. Here's what I did. I cheated. I could not get a rating, but I was able to get a political risk score. There's a service called Political Risk Services. It's a Europe-based entity, which actually comes up with a number for a country. Higher numbers mean you're safer, lower numbers mean you're riskier. The highest rated country in the world for them is Switzerland, 94, and the lowest rated is Syria, 38. So they have 168 countries for which they have scores. Guess what I did? I went and found the score for Syria, and then I went and found the score for a country for which I had a rating, which had a score very similar to Syria. Then I use that. You're reaching, but what choice do you have? So that's my filling in the rest of the gap for the rest of the world. So I don't think now there is a country that's left out. Right? So if you find one, so you go to my Excel spreadsheet, some I've not listed, the Caribbean for instance. No point listing Jamaica and Antigua and all that stuff, but it's on my website to put it up. Yes?
For some countries like Syria, some banks are making difference between which area is under control of this world.
Yes.
No, absolutely. Oh, they want you to turn the mic on, they can't hear you, so. Yeah. Is it on?
So I was telling that I was telling that there are some countries in which they are making risk assumption for some area and other risk assumption for other areas, and Syria is one of them. For example, there is a different risk for Eastern Syria and another risk for Western Syria. It's not me telling this. It's really the biggest bank telling me.
You're absolutely right, because you're saying Syria 2 years from now might not be Syria. Maybe it'll be 4 different segments of Syria.
Yes, and the same in Iraq with Kurdistan and the rest, same in many countries.
I don't disagree with you. I'm not going there though. You see why? Because the last thing I want to do is get pulled in. You'd be amazed at how much blowback I get just from this page. I told you yesterday, this is the most downloaded data set. It gets downloaded probably about 30,000 times a year. It gets used in the strangest places. Like what? I remember getting an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand. And the email said, we're setting milk prices for New Zealand farmers using your equity risk premiums. I said, what? Zimbabwe? But usually the question's a pretty direct one. How do you come up with these risk premiums? And I said, look, this isn't rocket science. It's default spread scaled up, and I have this little PDF document I sent up. So that was easy. But some are more difficult. I'll tell you my least favorite email of all time. March or April of 2009, I get an email from Lebanon. Pretty excited. I don't get that many emails about valuation in the Middle East. I open it up. Here's how it begins. You have destroyed Lebanon. So what? I can see myself destroying Luxembourg or Liechtenstein or one of these quasi-European cities you can walk through in 15 minutes. What, Liechtenstein is not?
No, to destroy Lebanon.
That's true. It's not nice. That's why I said, what did I do after 25 years of civil war and Hezbollah? I'm the guy who destroyed Lebanon. So I keep reading, what the heck happened here? And it's a Lebanese business person whose business had been appraised for value, who was writing. The appraiser had used the equity risk premiums from my site to value the business. See Lebanon right there? 14. That number was 16% in April of 2009. Rating was bad, mature market premium was high. You see why why this guy was pissed off, right? He put in a 16% risk premium, your discount rate goes through the roof, your value drops down. He felt he'd been gypped.
Who was the businessman?
I won't name names, right? I won't name names. Don't want to get in trouble. But he felt it was my fault. My response was, not my problem. Take it up with your appraiser. I did try to protect myself because I didn't know the email was from Lebanon. So I said, I have to find somebody else to blame. Whose fault is it that the premium is so high? I'm just a messenger here, right? What am I doing? I start with the rating for the country, and if it's in the toilet, you're going into the toilet with it. I said, it's not my fault, it's Moody's fault. You want somebody to take it out on Moody's. I'll give you their address if you want to put in your GPS, but don't come near me. Do you know that in this summer I can look at the geographies of where people are looking at my website? And the usual culprits are pretty easy to. The US is the biggest, then you got India, and in all the English-speaking countries. So you got Australia, then you got there's a fair number in German, and for the last year I've been noticing Lithuania show up in my top 10 list. Either Lithuanians are madly interested in finance, or something is going on here. How big is Lithuania? Like 2 million people. So what the heck is going on? It turned out that the Lithuanian natural resource, there's a government commission that looks at bids for Lithuanian natural resources, and they were using my equity risk premiums as a basis for judging these contracts. So a lot of people coming in to look at my equity risk premiums, I guess because they wanted to build it into bids. The only point I want to make here is there is no intellectual firepower behind these numbers. They're only as strong as their weakest link. And what's the weakest link here? I'm building it off a default spread. I'll give you the parts of the world where I'm most concerned about this. I was just in Dubai a week and a half ago doing a seminar with Middle Eastern companies. And right now, if you look at the default spread for Saudi Arabia, it's small. Why? Because the default risk in Saudi Arabia is low. Do you see where I'm going to go next? If I build an equity risk premium off the default spread for most of the Middle East, I'm going to understate the risk of these countries. That's the downside of going with the default spread. So every year I keep looking for ways I can get away from default spreads because I want an equity risk premium. I haven't found one that I can use for enough countries. I can find some that I can use for 20 countries, but I want something I can use for the world because I need the whole world in front of me when I look at valuing companies. So at this stage, let's pause and ask that question about a company that you're looking at. So if I ask you, what risk-free rate should I use for your company, what is the answer going to depend on? No, revenue percentage doesn't matter for risk-free rate. What currency do you want me to do the analysis in? Right? Remember I said currency was a choice. With Vale, you could do it in dollars. So once I tell you that currency, the next step is you want a risk-free rate in that currency. Less work in dollars or euros, but a little more work if you decide to do it in reais or pesos or rupees or rupiah. The risk-free rate is nailed down. When I ask you what is the equity risk premium for your company, then you're going to tell me the revenue sources because I'm going to take a weighted average. So you've got 2 of the 3 numbers we need nailed down. Incidentally, in the Bloomberg packet for your company, I think in the fourth page of the description of your company, so it's like the sixth page overall, there is a very rough breakdown. Right? So it's on the fourth page of the description. So there's a very that doesn't help you much. Worldwide. See, that's kind of useless stuff that some companies do. There's a very rough breakdown there, right there, of revenues for your company. Remember, this is a project that's not due till when? February 29th, right? So at the right now, if I ask you to complete the equity risk premium, that's the crappy information you got to base it on. You go home, you have nothing to do for the next 4 weeks, right? Nothing catches up with you. Right? You can download the annual report for the company and look this up for yourself, because now you have the basis for building an equity risk premium. So if you're lazy, use this. I'm not, if this is what you want to use in a project, I'm fine with it. In fact, if all you want to do is stay with this packet in your report, I'm okay with it. But I'm not going to stop you going out and finding out more about your company to the extent that you can, to see where it gets revenues. And you will be frustrated, just like I was with some of your companies. Frustrated, why? Because they're not transparent about where they get their revenue, what they do business with. And
what is worldwide? What do I do?
just take the average, the ERP globally, with the GDP weighted ERP globally is 7.39%. Basically, I took every ERP, took the weighted, so basically that's okay. You wish you had better information, but that's all your stuff.
Do you have export just like the others?
Export to the rest of the world, exactly. That's again this problem of some companies, the way they report stuff. Right. Yes?
Couldn't you find a lot of countries where you have an equity market which you could use and then do an implied equity risk?
That's a good question. Did everybody get Martin's question? Remember how I got the implied equity risk premium for the US? Using the S&P? You could do an implied equity risk premium for India, China. I'll tell you the reason I haven't opened that door yet. Getting the index in every country is easy. Getting the cash flows from last year in every country is pretty easy. Getting growth rates in earnings for longer periods than a quarter or a year is still difficult. It's going to change because increasingly information is starting to come in about longer term growth rates. There will be a time where I'll be able to do the implied premium for every country. It'll be a lot of work, but it's doable. Yes, sir?
Did you try at alpha z-scores for countries?
Why go the convoluted way when you can get a direct way, right? The Altman Z-score is really a company-specific score. At a country level, it tells me absolutely nothing. I'll tell Ed this to his way. It's really in corporate finance. I mean, if you were a high yield manager and all you care about is fixed income, use the Z-score. Corporate finance, I've never used the Z-score in 30 years. Looking at a company, because it doesn't help me from a corporate finance perspective. It's really for investors in fixed income trying to make judgments about default risk when they don't have direct knowledge.
How different they are from, for Middle East.
How do you get an Altman Z-score for a country? You got to come up with these proxies for working capital. I mean, you go through the ratio. Everything's proxy. So I guess you could come up with a number. You know what they're not going to capture? Why is the default risk in the Middle East higher now than 6 months ago? Because oil prices are at $27 a barrel. You know what the Altman Z-score will tell you, because it's based on historical data. It's going to miss that. The problem with default risk in all its different measures is it's backward looking when what you worry about is in the future. So I don't think it's going to be that useful to you on a country basis. There are much richer avenues to go. Yeah. Any other questions? So we've got a risk-free rate, we've got an equity risk premium. What's the last number we need? Oh, we need a beta. Let's finish the process. The beta for the stock, let me remind you again, measures what? The portion of the risk in your company that you cannot diversify away. Market risk. And let's set the table on betas. When I give you the beta for a stock, it's going to be scaled around 1. What does that mean? An average risk stock has a beta 1. And above average is above 1, below average is below 1. A riskless stock is 0. So if I can give you a beta, you're home free, right? Because you take the beta, you plug it into the model, you're done. And here are 2 other things about betas that I'm going to draw on as I go through the process. The beta for a portfolio, so if you have 10 stocks in your portfolio and say, what's the beta for my portfolio? It's always a weighted average of the betas of the individual stocks in your portfolio. What does that mean? I take each of the 10 stocks, I betas for each of them. You tell me how much money you have in each one. I take a weighted average. Got the beta for my portfolio. I'm going to draw on that proposition. And the second thing that comes just out of this description is you can have a risky stock with a really low beta. Explain to me how. How can a really risky stock have a low beta?
Because it's not related to the market.
In other words, you have a betting company. No, I won't call you gambling, but a betting company. It might turn out that the revenues for a betting company have nothing to do with the economy. It is very risky, but the risk I'm capturing. So get ready for that. There'll be some companies you look and say, that's a risky company, but its beta could be low. I'll give you a sector where this is going to be particularly useful for you to think about. Are biotechnology companies, especially young ones, very risky? Yeah. Why are they risky? What makes them risky? In other words, drugs are working through the pipeline. If they make it, you could be worth a lot. It's a blockbuster drug. If they don't, you're done. Very risky, right? But will they have high betas?
No.
Tell me why.
Because the risk is not related to the market.
And let's be more specific. Whether the FDA approves a drug or not is not based on whether the market is up or down, right? I hope. So much of the risk is firm specific. So I want to set the table for separating total risk from beta risk. We're measuring two different things. Now, of course, if I put all my money into the biotechnology company, do you see the problem I'm going to face? Is I can't use a beta. It's silly for me to use a beta because I'm exposed to all the rest. So we'll come back to that with Bookscape, and I'm going to give you a template for what to do when you have an investor who's not diversified. But if you have a diversified investor, beta measures the risk you're exposed to from the market.
But like the companies you given, so it's a company beta, specific company beta we have to use.
It's a beta for an investor, right? The beta for the market is 1. So now the question is, how do I come up with the beta?
Sorry.
I'll tell you how I was taught. Yes, go ahead.
I'm trying to understand that why the beta of that particular scenario. The idiosyncratic risk typically is implied in the stock price anyway.
You're making a leap. If it is, why would it be implied in the stock price? Why are you saying it's implied in the stock price? The expected value of the drug working is built into the stock price. Mm-hmm. That's not risk adjusted. So let's say there's a 90% chance the drug will not make it and a 10% chance it will. And if it makes it, it's worth $1 billion, and the 90% of the time it doesn't, it's worth nothing. What's the expected value?
Yeah.
It's 10%, but it's not risk adjusted. So what we're talking about is, should we be adjusting that $100 million down further because it's a risky number? And if the answer is it's all coming from these random probabilities, you're done. 100. So you can just use expected values if the risk is completely not market related. So I'll tell you how I was taught betas, and my guess is you were taught betas the same way when you did foundations. This is about 35 years ago. I'm sitting in my first corporate finance class. Professor comes in. We're going to talk about betas today. He says, to get a beta for a stock, you run a regression. Already your mind is scrambling. Oh my God, that statistics class. I sold the book back right after the class was done. Maybe I should have listened more closely. And some of you are feeling that same sense of panic, right? But it's a very simple regression of returns on the stock against returns on a market index. The slope of the line is the beta. Now part of you think, why? The slope of the line is determined by how the stock moves with the market. In other words, if the stock moves like a biotechnology stock, if the movements in the stock have nothing to do with the market, the line's actually going to be a flat line. The beta is going to be 0. The more a stock moves with the market, the more the slope is going to move up, and the beta will reflect then the risk in the stock. That's it. The slope of the line is the beta. Horrible way to think about betas, because it makes it a statistical number, right? I'm going to come back and animate that number, but that's the way I was taught betas. But don't just leave, because that regression has 2 more pieces of information that you might be able to use. When you run a regression of a y variable against an x variable, you get a slope. What else does the output give you? There is an intercept, and there's an r squared. You think this is in the statistics that you read. But I'm going to use that intercept in R squared from a finance perspective to learn more about the company. What does the intercept tell me? The intercept, I'm going to argue, and I'm going to back this up, tells me whether my stock was, keyword is was, a good or a bad investment during the period of the regression. Let me ask you a question. Was Amazon a good investment over the last 2 years? 2 years ago, the stock was trading at $152. Today, it's trading at $550. You don't need to do any math to figure out you wish you'd put all your money in Amazon. But that and a dollar will get you a cup of coffee. The intercept is going to tell you whether the stock was a good investment. Was Glencore a good investment over the last 2 years? Are you kidding me? What about Vale? I don't need to do the math. But the intercept for these stocks will basically tell you whether the stock was a good or a bad investment. And here's what. In the CAPM, the expected return on a stock is the risk-free rate plus beta times its risk premium, right? Whatever you earn over the risk-free rate. If you do the algebra, just work through the numbers, if your stock did exactly what the CAPM predicted during the regression period, the intercept should actually be the risk-free rate multiplied by 1 minus beta. So it's actually what you'd expect. So before you even run the regression, you know this is what it should be if your stock did exactly as predicted. When I run this regression for Amazon, you know what I'm going to find? The intercept is much, much bigger than that number. Why? Because it did much better. If I run this regression for Vale, it's going to be much, much lower. Why? Because the stock did worse than expected. In fact, the difference between the intercept and the risk-free rate times 1 minus beta is called Jensen's alpha. You're saying, who the heck is Jensen? And why did he come up with this alpha? This has a history that I think is part of the history of finance. In 1969, Michael Jensen asked a question. And at the time he asked it, everybody thought they knew the answer. And his question was, do professional money managers beat the market? And in 1969, the presumption was, of course they do. Otherwise, why would they be professionals? So people handed their money to mutual funds, saying they must be professional. They know so much more. They have all these resources. But he asked a question, do they beat the market? So what's the question he's asking? After correcting for risk and the market, do mutual funds deliver positive Jensen's alpha? That's basically what it is. Do they deliver more than they should? At the time, there were 125 mutual funds. Thank God for smaller databases. He had to collect them by hand. So he took 125 mutual funds, he computed the Jensen's alpha for each one. And the results he got in 1969 with those 125 funds, those results are among the most enduring results in finance. What do you think he found? Do professional money managers beat the market? In 1969, his conclusion was 86 out of the 125 mutual funds delivered negative Jensen's alphas. So all those analysts, all those resources, at the end, they're actually getting less than what you'd have made if you hadn't even tried. Strange business. The analogy I can think of is like starting a plumbing business and calling it Floods or Us. And what you do is somebody has a leak in their house. They call you and leave a flood. You wouldn't be in business too long, right? The average Jensen's alpha across mutual funds was between -1 and -1.5%. That again is one of the more enduring results in finance. Collectively, active money managers earn to 1 to 1.5% less than the market. Of course, I know if you're an active money manager, some of you are, you're special. I know that, so I won't pick on you. You're not the one I'm talking about, it's the other guys. Let's act like they're all outside this room. But collectively, this business is a screwed up business. Yeah.
If all the money is managed by money managers, there is nobody else, then the market is set by them, right?
That's not true, because if they spend resources to actively manage money, somebody's got to pay for the analysts, right? Somebody's got to pay for the computers.
No, I'm taking that out. What I'm saying is...
You can't take that out. That's the -1%.
No, I'm
right?
making a different point. Let's take that out.
Yeah.
Let's say that all the money is managed by money managers.
Okay.
Then half of them are anyway going to be on negative.
That's absolutely true.
Okay. That's what
but then but the next step you have to show is the half that beat the market do so consistently. Then we have a basis for active money management, right? If which side you fall is purely random. 1 year you beat one, then this becomes an almost pointless exercise, right? And that's the second part of these studies, is they look to see whether active money managers win consistently. 50% are going to win every year. No? But if it's not the same 50%, that's then the problem you start running into, is this entire exercise an exercise in futility. And I will leave you with that existential question if you're an active money manager, because it cuts to the core of your existence. Okay? You've got to find a way to create value, but that's the Jensen's alpha that you're going, and we're going to use it for individual companies. He used it for mutual funds, but that's what we're going to use for individual companies. Yes?
Are the numbers consistent today?
1.5%. In fact, it's scarier. I used to have the presumption that maybe in emerging markets, active money managers do better than in developed markets. And it turns out emerging market money managers deliver, guess what? 1.5% less than the indices for their markets. I used to think that growth money managers did a little better than value money managers. Guess what? Growth money managers and value money managers deliver less than the indices. It is, I mean, it's one of the most depressing collective set of numbers you can look at. Is you look for any possible slice of hope, and you get bludgeoned. Maybe there, maybe here, maybe here. Oh, no. Okay? It is a tough business to win. It's not an impossible business. We know names of people who have. The very fact, again, like yesterday, when you can name names. Okay? In fact, every time you bring up the words Warren Buffett to defend active money management, you've admitted you failed. How many times can you keep bringing up this guy? Oh, active money management, look, it's Warren Buffett. Come on. If that's all you can draw on after 50 years of active money management, you've lost the game. This is an incredibly difficult game to win at. Okay? And, look, I mean, it's not the topic for this session, so I'm not going to go deeper in there. But it's worth thinking about, because there's a very simple proposition that I draw on. If you don't bring something to the table that's special or unique, don't expect to take anything away. See where I'm going? I talk to hedge fund guys, and these guys think they rule the universe after 2 good years. And he said, well, what do you bring to the table? You know what they show me? Oh, look at my returns for the last 2 years. I'm saying, that's not the question I asked you. What do you do that's different and unique? So, look at my returns for the last 2 years. I said, that's not what I'm asking, because if you can't, and that's, I think, the question we need to ask people who ask us for our money. We let them, almost bludgeon us with past records. That's like a guy coming out of a Vegas casino saying, look, I made $500. I must be a master of probabilities. No, you just pull that, the one-hand lever on that machine and you got lucky. 95% of what you see in hedge fund performance is pure luck. It's being in the right place at the right time. That 5%, there's something behind it. That's what you're looking for if you're trying to invest your money. So the intercept tells me something about performance. Yes, go ahead.
Just one point.
Yep. I'm sorry, what did I do?
Jason's alpha.
Oh, it should be worse. You're right. Cross that out. Sorry. Thank you for spotting that. See this, if it's less, it can't be better in all three, right? So in fact, it should be better as well as and worse. I must have been in a daze when I was doing that. So stock did as well as, stock did worse. So put that in, because tomorrow's quiz, if you get that wrong, I don't want you blaming you. Your notes misled me. It's better no matter what happens. It's not, right? So better is the first line as well as worse. So better as well as. And
one line up. What's the constant alpha bracket? A minus, so it should be like.
It should be outside, yeah. It should be outside bracket as well. Yeah. Sloppy, so fix it. Right? What is the R squared in statistics measure? Give me the statistical definition of R squared. Andre, what?
We are supposed to know that what the share of volatility is explained by this particular.
The proportion of the variance in your dependent variable that is explained by your independent variable, right? What's your dependent variable here? The stock. The independent variable is a market. So when I say the R squared is 30%, what am I saying? 30% of the risk in your stock comes from the market. Now we're starting to put some. Remember that second step in risk and return models? What did I say? You get rewarded only for the portion of the risk that comes from the market. The R squared tells you how much of the risk in your stock comes from the market. So you ready? Let's set this process up for Disney. You think, what do you mean set the process up? What did I say? The beta comes from a regression of returns on the stock against returns on the market. Embedded in that statement are lots of judgments I've got to make. Let's take Disney. First judgment I've got to make is, how far back should I go to run this regression? Disney has been a publicly traded stock since the 1950s. I could go back all the way to 1956. So it's good, right? Statistics, more data is better than less data. What is the trade-off here? If I go back too far, what do I risk doing? What did Disney look like in 1956? Disney didn't even have a theme park yet. They were building Disneyland. They produced one animated movie every 3 or 4 years. It was a single movie company. It was closer to Lionsgate. You know what Lionsgate is, the producer? It's one movie every 3 or 4 years. That's what Disney looked like in 56. I want a beta for the future, not a beta for the last 50 years. So the trade-off is, if I go back too far, I get a company very different from mine. If I don't go back far enough, I don't have enough data. My default is I go back 5 years if I can. And if the 5 years look a little tricky, if I take HP, 5 years already you're looking for trouble because you're getting the split happening in the business, I might go back 2 years. Most services use 2 to 5 years. Second decision I have to make. Let's say I decide to go back 5 years. I have to decide how to slice up the data. What am I talking about? If I take 5 years, I can look at daily returns every day for 5 years. That's almost 1,250 observations. I can look at weekly returns, which is about 260 observations. I can look at monthly returns, which is 60. Again, the statistics part of your brain is saying more is better. There's a trade-off again. As you start slicing up the data finer and finer, you introduce more noise into the process. Why? Because you don't get trading at the close of trading every day. You get like a trade at the last trade happens at 2:35 and then this market keeps trading. You get problems. Daily return betas are very noisy. That's why most services stick either with weekly or monthly. So how far back? How am I going to slice the data? Third, I have to estimate returns. Okay? So basically, what does that mean? Well, there are two ways you make money on stocks, right? One is dividends, and how often do you get them? For a US stock, it might be once every 3 months. For a European stock, it might be once every year. Which means you're not getting dividends in 11 months out of the year. You're going to get dividends only. Don't try to be fair and spread it out. So you're going to get dividends in periodic intervals. What's the other component of returns? The change in the price, which can be positive if you're lucky, or negative. So the return for Disney will then be computed as a change in the price plus the dividend if there is one in that period. So I've decided how far back to go, whether to use daily, weekly, monthly. I've computed these returns. What's the last step? I need to get the market, right?
This return interval, the dividend is declared quarterly or yearly, but the
payment, it's not when it's declared, it's when you get paid. So whichever month you get paid.
So the price also you will check during that time?
That'll automatically happen, right? The price change always gets checked. So if you get a dividend in that month, the price will adjust. That's why you don't have to worry about spreading the dividends out. The price adjusts for the ex-dividend. Last choice is I have to get the market. Now you see why this choice is also a choice. In the US alone, there are 123 different market indices. 123. So let's start with the ones that we've heard about the most. When people still talk about the market in the US, for better or worse, what's the market they're talking about? The Dow 30. Why? Because it has the longest history. So when you listen to the 6:30 news in the US and they say the market is down, the first number they're going to give you is the Dow. Dow 30. The next most widely mentioned index is the S&P 500. Then you got the NYSE Composite, Wilshire 5000. Then you keep going. And you get to pick whichever index you want, right? And this drives people crazy. What do I do? Which index is best for me? Should I pick the index? If I'm on the NASDAQ, should I pick the NASDAQ as my index? Here's the answer. What are we trying to estimate? The beta in the CAPM, right? That's what. And what do we all end up? Remember yesterday we played this little game in the CAPM where he said no transactions cost, no private information. We all ended up holding what? The market portfolio. And what's in it? Everything in the market. The closer you get to that, the better your beta is going to be. Now let's go down the list. Would you ever use the Dow 30 in a beta regression? No. Why? It's only 30 stocks. Throw it out. What about the NASDAQ? What's the problem with the NASDAQ? It's not a market index. It's a tech index with 5 big tech companies. That's out of the window. Almost by default in the US, you see why people end up with the S&P 500. It's only 500 companies, but it's market cap weighted, so that's about 70% of the overall market, and you have a history. There are people who try to use the Wilshire 5000, the value, and there are choices. The only thing is they don't have, see, with an index, you got to trust the index. You got to trust how the index is constructed. I don't like some of the things S&P 500, the S&P does with the index, but I understand how they add stocks, how they take stocks out. I'm comfortable with the index, but I'll tell you the problem with using the S&P 500 index. When I did the CAPM, we talked about the CAPM, and I said you're going to end up with a market portfolio. In that market portfolio, you had every traded asset, just in the US. There's no reason why you have to stop at borders, right? And that's, I think, the next frontier in beta. We're still too parochial about the way we estimate betas. You know what I mean by parochial? You go to Bloomberg, you look for a beta, and this is actually going to be true for your beta page. I asked for a beta for a German company. What does Bloomberg do? It runs a regression of Siemens against a DAX. I asked for a beta for a French company. It runs a beta for LVMH against a CAC. I asked for a beta for a US company. It runs it. And maybe this made sense 30 years ago. It doesn't make any sense today. It's going to happen. Sooner or later, service is going to do the right thing. But that's the final choice. So let me show you how these choices work out for this.
And the implication of that, just so I understand it,
Yeah.
is the global diversification.
Exactly. The marginal investor, if it's BlackRock, if you get a chance, this is actually, if you're paranoid, this will freak you out. Print off the top 17 stockholders for the 10 largest market cap companies, any country in the world. I was in Indonesia. I printed off I did this for the top 15 Indonesian companies. Every single one of those 15 Indonesian companies, BlackRock is there. BlackRock. BlackRock, I think, owns the world in terms of how many. So that's what I'm talking about. The more you get the BlackRocks driving prices, when they think about risk, they're going to measure risk against what's in their portfolio, and it's a global portfolio. Saying, but what about poor me? I'm not globally diversified. Sorry. But you got to play the game as it's being played out there. So in a sense, we all have to think like global investors, even when we're not global in our portfolios, because that's the way things are being priced. So here's my Disney beta pitch. I could do this by hand, right? It's not rocket science. In fact, if you go to my book, I actually collected the price data every month and the dividends and ran the regression in Excel myself. But it's a little tedious to do it. And one of the nice things about having a Bloomberg terminal installed 15 years ago at Stern, and we have like 4 or 5 in this building, is you run the beta for a company. You can just look it up. It's a mixed blessing, as you'll see, right? So you pick any stock, 41,889 companies, you type in the word beta, this page will pop up like magic. So there's your regression line, right? Slope of the line is 1.245. Third decimal point is always the fallback for anybody who feels uncertain. Add decimals. 1.245. So if you trust this regression, the beta for Disney is 1.25. We're done. Almost. But let's use the rest of the regression. The intercept on this regression is 0.57%. Bloomberg is extremely sloppy about decimals and percentages. So that 0.572 is already in percent. Don't ask me why they do this. It drives me crazy. But it's 0.57%. You say, what do I do with that? I subtract out the risk-free rate during this period, which was 2008 through 2013 in the US. The average short-term, this is because you're looking at monthly risk-free rates, the average T-bill rate was 0.5%. So I subtract out, not the 0.5% because it's an annualized number, but 0.5% divided by 12. Why? Because I'm using monthly returns in my regression. If I were running weekly returns, you know what I'd have done differently, right? I'd take 0.5% and divide by 52. Daily returns, take 0.5% and divide by 250. I'm trying to stay. And I multiply by 1 minus the beta. The beta was the 1.245.
What's the 0.5%?
That's the average T-bill rate over between 2008 and 2013. Monthly, exactly. I end up with 0.58%. You say, what does it even mean? On a monthly basis, between 2008 and 2013, Disney delivered 0.58% more than expected. By whom? by you if you believe the CAPM and you look at what the market actually did. It's a risk-adjusted, market-adjusted measure of performance. He's saying it's only 0.58%. Remember, it's per month. 0.58% a month is about 7.19% a year. So the way to read this is not that they made 7.19. They made 7.19 more than expected. I'll give you a very simple example to kind of bring this home. Let's suppose you have a stock with a beta of 2. Say the market is up 20%. Say the risk-free rate is close to 0. How much would the stock need to make to break even? Market's up 20%, beta is 2, so it's twice as risky as the average stock. So it would have to make 2 times 20%, which is 40%. When I say the Jensen's alpha is 7.19%, you know what I'm saying? It made 40% plus the 7.19, 47.19%. It is over and above what you need to make given the risk and given what the market did. So here's what we learned. Disney is a risky stock. It's 1.25 times more risky than the typical stock. It did well between 2008 and 2013. Please don't do anything stupid with the Jensen's alpha. You know where I'm going, right? Just because a stock has done well in the last 5 years, this is not a recommendation for you to go buy Disney. It's more a sense of you wish you'd bought Disney, but it's too late now. Right? And let me complete the process. That beta 1.25, it's time for some truth in advertising. Every time you run a regression, you get a slope, but the slope has a standard error associated with it, right? You remember that in statistics? In fact, see this number, standard error of beta 0.10, roughly speaking? How would I read that? If you ask me what the beta for Disney is, and you ask for a single number, it's going to be the 1.25, but that standard error is going to allow me to come up with ranges for the beta. A beta is not a fact, it's an estimate. That's why you can look up, for the same company, betas in 5 different services, all of which claim to run regressions, and you can end up with 5 different numbers. Why? Because they're pulling from the distribution, and depending on estimation choices, you get different answers. Finally, the R squared, the regression, was 73%. What does that tell me? At least in this 5-year period, 73% of the variation in Disney came from the market. That number was 30%. If you look at the 2003 to the 2008 crisis, in a sense, almost flipped a switch and made more of the risk in Disney market risk. This is the nature of any crisis. Almost everything that. I mean, take a look at all the stocks in your portfolio. What did they do yesterday? Whatever the market did. You become a creature of the market, because that's what crises do. One final number I haven't talked about is saying, what the heck is the adjusted beta? You know the adjusted beta? Sounds fancy, right? It's your regression beta, and hang in there. It's regression beta times 2/3 plus 1 times 0.33. So it's a weighted average of your regression beta and 1, with a 2/3 weight on your regression beta and a 1/3 weight on 1. You're saying, what the hell are these guys doing? Let's put some numbers. If your raw beta is 1.8, your adjusted beta is going to become 1.53. If your raw beta is 1.5, it's going to become 1.33. So I want you to start looking at patterns. 1.8 becomes 1.53, 1.5 becomes 1.33, 0.6 will become 0.73. First, what am I doing? I'm pushing betas towards 1. What's so magical about 1? It's the average across the market. I'm trying to help you. I'm saying, you know what? Your company will probably get bigger over time. It'll probably get more diversified over time. And if that happens, what will happen? Your beta will start to which your response is, please stop helping. Because these weights of 2/3 and 1/3 must be magic weights, right? Because that's exactly the same weight that Bloomberg uses for every one of the 41,889 companies. The adjusted beta is always that weighted average. Be unfair for me to ask you where those weights come from, because I didn't know. So I called the company. I called Bloomberg, not the mayor, but the company. I should have called the mayor then. Maybe he'd have given me a better answer. And they put me in touch with the beta calculation guy at Bloomberg. There is actually a guy at Bloomberg whose life it is to maintain this page. You know how exciting his life must be? He goes to a cocktail party and says, I'm the beta guy from Bloomberg. Dozens of people gather around for anecdotes. Not. He's pathetically grateful to get a call from the outside world. I don't know what they do to the guy. Maybe they keep him locked up in a basement room and feed him through a hole in the wall, whatever it is. He says, I'm so glad you called. I have all day to answer your questions. I have all day to ask him the questions. I'm afraid if I hung up the phone too soon, he might do something rash. So after what I thought was 5 or 10 minutes of polite conversation, I hit him with a question. Why 2/3 and 1/3? Where did these weights come from? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. Finally he comes back on and says, I don't know, it was here when I got here. So what does that mean? He said, I was hired 2 years ago. It was already here. Don't blame me. I said, I'm not blaming you. I just want to know where the numbers come from. He said, I don't know. Here when I got here. I just told you yesterday I finished my 11th book over the break. Or maybe I didn't. But I have my 12th book all ready to go. The only thing I'm ready to go is the title. You know what my 12th book is going to be called? Here when I got here. Because you know how often that is the answer to questions you ask about numbers you use every day. Why do we do that? I don't know. Here when I got here. When did you get here? 1979. You never asked? Why would I ask? Oh no, lift rocks up and look under them. I just do whatever I'm told to do. It's amazing how much of corporate finance and valuation we've outsourced. You get your betas from Barra, your equity risk premiums from Duff and Phelps, your risk-free rate from the Treasury. What the hell are you doing? In fact, you get your earnings and cash flows from the managers. You're like a concierge that's collecting numbers, putting it into a spreadsheet. That's not what this is supposed to be. But this is the basis for every beta service that comes up with betas. Whether it's S&P, Barra, Bloomberg, they claim to do fancy stuff, but it's all based on regressions, different choices that they make. And this adjustment towards one that might be slightly different for every service. So at this stage, no, yep, go ahead.
Quick question.
Yep.
Does this always depend on the market dynamics, or is there any relation to the capital structure?
It does. I mean, we'll come back and talk about what is it that drives the beta. So we'll come back and address it, because your choices on debt can increase or reduce your exposure to macroeconomic risk. Your choice of business you're in, how you run that business can affect it. So we'll come back and talk about the fundamentals that drive beta. Yep.
I didn't understand eventually why do we need adjusted beta?
We don't. I don't use it. The only thing an adjusted beta tells you is which direction one is. And if you have doubts about that, don't do corporate finance. So if you're at 1.5, you want to get to 1, you know how to get there, right? 1.4, 1.3, 1.2, 1.11, you're there. Why do you need some guy holding hands saying, let me give you a number closer to 1 in case you're confused? That's all it. So I agree with you entirely. When I look at this beta page, the first thing I do is I take a pen and I cross out the word adjusted and beta and the number next to it, because it tells me absolutely nothing. But you know what the most insidious thing about it being called adjusted beta is? It sounds like it's adjusted for something. And what's the true answer here? What is it adjusted for? Absolutely nothing. I've seen equity research analysts, value companies, and once in a while I get to sit in the audience while they do this. And I do it just to be a disruptor. So after they finish the valuation based on adjusted beta, I put up my hand and say, I notice you use an adjusted beta from Bloomberg to value the company. What is it adjusted for? And you can notice this moment of stunned silence. Say, what? It's adjusted. For what? It's adjusted. So in fact, every service doesn't play with this predicted betas. Predicted, what does that mean? Forecasted betas, special betas. These are all regression betas, moved towards 1. Might as well just call them what they are. Yes?
You could probably think that Bloomberg has to invest several millions to take that out of the system. Maybe that's also...
And you know what? Why should Bloomberg care? Bloomberg is a data provider, right? There's 90% of the stuff in Bloomberg you use at your own risk, right? Basically, they're data providers. Blaming Bloomberg for the adjusted beta makes no sense. It's the people who use adjusted betas have a problem with, not Bloomberg for reporting an adjusted beta. The only time I wrote to Bloomberg about this is initially when they created this adjusted beta. At the bottom of the page, they had a weighted average to get, and so it used to show it right below the box which they've taken out to make it look more mysterious. And it said the adjusted beta, listen to this as I go along, is 0.66 times the raw beta plus 0.33 times 1. And I had to email them. You know what I emailed them, right? 0.66 plus 0.33 is 0.99. I said your weights don't add up to 1. We can debate with them, but first get them to add up to 1. They did fix it right away. But that was the only time I emailed them, because then I was a little wary of it. Maybe the weights don't add up here, right?
One more thing.
Yep.
What are the other things that are needed?
That's it. We're done. There's nothing else on this page. You just cross a whole line through it. There's nothing. It's all statistical gobbledygook.
Number of points.
Number of points is the number of months. So you shouldn't need to look at the regression. If it's 5 years, you're going to get 60 months, but you lose the first month because you need the price change. So that is not output. That comes from your choices. Now let me take this regression away. You have a question back there? Yeah.
If all companies are efficiently run, and the beta is 1.
No. That's not true. If companies are efficiently run, they will actually deliver a return given whatever their beta is. So if you're in a risky business, efficiently run doesn't make risk go away. It means that the returns you deliver will be commensurate with your risk. Do you see what I'm saying? You can't change the risk of a business by being efficiently run, but you can change the returns you deliver. So you're looking at the wrong side of the equation. And we'll come back to this, because I think if I look at a company and ask, is this a well-run company? The fact that you have a low beta or a high beta is really not how I should judge you, because it depends on the business you're in. It's how well you do given your beta. Right. Now let me take the numbers out from this regression and kind of build up. Jensen's alpha, 7.19%. That's good, right? So I'm going to play the role of Bob Iger, CEO. You're going to be Disney stockholders. And I'm going to ask you for something, and you need to decide whether my argument is justified. I said, look, I did well for you guys. I delivered 7.19% more than I should have, given the risk and given what the market did. I'm a good manager. I need a bonus. You see what the question I'm asking? When you see a positive Jensen's alpha for a company, is it because, or can you jump to the conclusion that that company is well managed? Yes, Julio. Julio, it's Julio, right? Julio. Sorry. I just want to make sure what part of the word you're from.
You just made their day.
Why? Is this some kind of an inside joke that I'm missing?
Who's going to call it Julio?
Starts in September. Thank you.
See, I want to figure out, so basically, okay, go ahead. Yeah.
No, I was just going to say it depends on the percentage of APR as well. That's related to the market.
It's that and what else? Yeah.
Market conditions.
Market, let's get to more specific. When I look at the Jensen's alpha for any oil company today, what am I going to see over the last 2 years? Negative, right? Is it because the company is badly managed? No, it's because you're an oil company. So the first thing to remember is when you see a big positive Jensen's alpha or a big negative Jensen's alpha, the first thing you need to check is the entire sector. If the entertainment sector collectively made a 10% Jensen's alpha and you made only a 7%, if I'm Bob Iger, you know what you should tell me? Pay cut coming. Conversely, if I deliver a minus 10% Jensen's alpha, my entire sector is at minus 25%. So don't read too much into the Jensen's alpha about the quality. It's good to have a positive Jensen's alpha, of course, but it doesn't necessarily mean that the management of that company is a great management. And if I take the average Jensen's alpha across all stocks, what is it going to be? What does the Jensen's alpha measure? Did the stock beat the market after adjusting for risk? Collectively, if I look at all stocks, the average Jensen's alpha is going to be 0. So before you start complaining about your stock having only a plus 1% Jensen's alpha, you know what you should do? Get down on your knees and thank the Lord that you're on the right side of the divide, right? And the other way I think about this is I look at Amazon and part of me says, I wish I'd bought Amazon. And then the other part of me reminds me, says, thank God you didn't put your money in GoPro. It cuts both ways. Regret is easy. In investing, it's the most deadly thing in investing is you start regretting things you should have done. Then you try to fix it all by going out and doing it today. Let it go. Right? So Jensen's alpha is backward looking, but it's a useful number to me. The beta for Disney is 1.25. The standard error of that beta means that if you look at different services, what should you see? I look at Yahoo Finance, I'll see one beta. I go to Bloomberg, I'll see a different beta. Each service is going to, not because one service is right and the other is wrong, they're all drawing from a distribution, and depending on the choices they make, they're going to end up with different numbers. And if the betas are different, which one should you use? You could probably average off large numbers, but I'm going to give you a way of kind of escape. You can see why regression betas are almost a trap, because you can play with the starting and the ending numbers the market used to get the number you want, and it's a noisy number, right? So, but if you're stuck with regression betas, might as well average across lots of services and just use them, because none of them is right per se. They're all estimates. Which brings me to the R squared. If you trust this regression, 73% of the risk comes from the market. So I'm going to ask you a question as an investor. If you are a diversified investor, and there's a reason I'm putting the word diversified, you're like a Fidelity or a BlackRock, do you want that R squared to be a high number, a low number, or you don't care? High, I hear high, I hear low. Does any know? Let's complete the trifecta here. Somebody want to be the don't care? I'll be the don't care. Let's think about why. If you're a diverse, so let's, in this case, the R squared is 73%. 27% is firm specific, right? As a diversified investor, what happens to that 27%? It goes away. So let's say the R squared had been 10%, and I invest in this company. I'm a diversified investor. 90% is firm specific, but after I'm done diversifying, what happens to 90%? It goes away. If you're a diversified investor, you don't care. Why? Because you got a portfolio. So if you bought GoPro with a low R squared, you can live with it as a diversified investor because you got 500 other stocks in your portfolio. Now let's make it interesting. Let's say you're one of those crazy aunts or uncles. You know what I'm talking about? Paranoid, will not trust these mutual funds. We'll pick only 3 stocks. Don't ask me where that came from. 3. That's all we pick. 3. I read in a book somewhere. 3 stocks is what you have to buy. They ask you for some advice. My first suggestion to you is don't give advice to a crazy aunt. Nothing good comes out of it. But let's say you feel fond of this aunt and you decide to give some advice. So now we're talking about an undiversified investor. Now do you want a low R squared or a high R squared? You want a high R squared. Do you see why? Because a crazy aunt invents in GoPro. What happens? Only 10% of the risk gets rewarded. 90% is not going to get rewarded, but because she's not diversified, she's going to be exposed to all that risk. And the analogy I give, it's like living across a highway from a brokerage house. 6 lanes, and every morning here's what you do. You get up and you run across the highway. You might make it, you might not make it. You get to the brokerage house, and then you tell me, look, I take a lot of risk every day investing in stocks. Why am I not getting a high return? The answer is, you didn't have to live across the damn highway. Live next to the brokerage house, or find a way to get to the highway which does not require you running across 6 lanes. You invest in GoPro and you're undiversified. You're going to be exposed to all this risk you should not be exposed to. So there I'd say, go buy GE. In fact, if I can fool her, I'll give her a symbol, SPX. Buy that stock, SPX. You know what SPX is? You get the spider, an index basically tracks the index. She won't even know. Oh, my stock seems to do exactly what the market does every day. Great stock. So the less diversified you get, the more you worry about R squared. So now let's bring it all to fruition.
Higher the R squared, the better it is.
Only if you're not diversified. If you're diversified, it doesn't matter. If you're not diversified, you want, and that's why you don't want somebody with 5 stocks owning Amazon, Netflix. You know, that's the most dangerous place to be. If you're not diversified and you put all your money into 4 or 5 very, very risky stocks, but most of the risk is firm specific. So we're ready. Remember, all this process was started by that one little hurdle. It took us a while to get there, but I think we have all the numbers you need. If you ask me what the expected return for Disney should be, I'm going to start with the risk-free rate. November of 2013 in US dollars, 2.75%. Okay, let's start. Remember how the equity risk premium is computed? It's a weighted average of where Disney does business. The first slide from today, 5.76%. There's the beta, 1.25. Risk-free rate plus beta times risk premium gives me 9.95%. You say, what does that even mean? We do this in finance classes, odd numbers. Risk-free rate plus beta times risk premium. And afterwards, I don't even know what that means. So let's put some meaning on it. Let's assume that this is November of 2013. Your question? Yeah.
Yeah, quite lost. I asked the other time, trying to bear my mind on efficiency, and you said that I shouldn't bother about the risk. Rather, I should consider I should.
First, are you a company or you're an investor? Let's be clear about whose perspective we're talking from. Are you a business? You see what I'm asking? Are you on which side of the equation are we from? Are you a business or you're an investor in businesses?
How does that matter?
Because as a business, you get less choice about what your beta is. You're a media company. Your beta comes from the fact that you're a media company. If you're a technology company, so if you're a business, you don't get to pick your beta. You pick the business you're in, and then the beta comes out of that business. You can't change it. You're in a risky business, your beta is going to be high. If you're an investor, you have more discretion. You can choose to invest in a high-risk stock or a low-risk stock. So that's why I asked. So which perspective are you taking?
But isn't the return you get as a company the function of how well you're able to manage your risk?
No, it's not how well you manage the risk. It's how well you take investments given the risk you've exposed to. I think, in fact, if you think of your business's job as managing risk, you've lost perspective. Is Google in a risky business? Has it done well? Is it a well-managed business? Yes. So why do we call them a well-managed business even though they're a risky business? Because they delivered 35% returns on the investments they took in that risky business, right? Conversely, I can ask you, is Procter & Gamble in a safe business? And the answer is they're in a safe business. But are they a well-managed business? No, because they delivered a return of 6% on their projects, even though they're in a safe business. So that's why managing risk is part of your job as a manager, but it should never be the focus of your job. It should be about going and taking investments that deliver a return given the risk you're exposed to. Perhaps, I think one reason I think managing risk comes to the top if you're in an emerging market is, let's face it, you could be the best run company in a country, but if the country goes to hell in a handbasket, what happens to your company? That's why I think and so I understand where you're coming from, because you're saying, look, I'm doing everything right in the company, but if this macro thing happens to me, I'm not. So we'll come back and talk about it, because I think that's a very legitimate point about how to run a business when the outside world is dictating so much of what you do. But it's a very unhealthy place for businesses to be in as well. So let's make this real. So let's say this is November of 2013, and you're all potential investors in Disney. You know what I mean by potential investors. You're thinking about investing in Disney. I'm going to give you a couple of statements about the 9.95%. You tell me whether you think these statements are reasonable ways of describing what the 9.95% is. First, 9.95% is the return you can expect to make. You're the potential investor, can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. How many qualifiers are there in that statement? Let's go. Long term, so don't come to me next year. If the stock is correctly priced, if it's not, all bets are off, and the CAPM is the right model for risk. I'm a lazy person. If I put in this many qualifiers, it's probably because I want to make the statement. So that is, in fact, one way to describe the 9.95%. It's a very, I don't like it because it's almost fatalistic. You see why it's fatalistic? Because we want to earn a higher return, then what do you need to do? Go invest in a stock with a higher beta. But in an efficient market, this is exactly what the 9.95% tells you. This is what you can expect to make, because that's a risk you expose yourself to. I'll give you the statement that I prefer to think of, this 9.95% as framed. 9.95% of the return I need to make. All of a sudden I've become a needy person. I need to make on Disney to break even on the investment. Let's break this down. What is the risk-free rate when I did this? 2.7. So why am I being greedy? Why do I need to make? Why can't I settle for 2.75% on Disney? Danger and open. Why expose myself to all that danger to make 2.75 when I can make 2.75 investing T-bonds? So it has to be more than 2.75. So the reason I need to make 9.95% is not because I'm greedy. But because I've exposed myself to risk, and to the extent that I've exposed myself to risk, I need to make enough to compensate. Yeah.
Couldn't the first piece of the sentence or just be the perspective of the manager? The manager needs to make a return.
No, wait. Managers have no. They're investing your money. I'll come back and flip this around on the other side. So in fact, you're absolutely right. But it's coming from the fact that you need to make it. Managers just reflect your needs. That's why it's so critical, right? So 9.95% return you need to make. So let's say you don't believe in efficient markets. What does that mean? You think you can find stocks that are cheap or expensive. You do your own research on Disney. You collect data on Disney. You look at its projects. You look at that California Adventure expansion. And based on your research, you conclude that Disney can make 12.5% a year. Do you see what that means? You need to make 9.95% given its risk. You think you can make 12.5%. This is my definition of a good stock to buy. I'm shocked when I run into equity research analysts who are proud about the fact that they don't get this CAPM stuff. So my job is picking stocks. If I use the CAP, so what does that even mean? Have you ever seen an equity research report? If you haven't, avoid the plane. But if you have, here's what you will see. You will see a stock price today, and you will see a target price 3 years out. I have never understood what I'm supposed to do with this. So let's say the price today is 50 and the target price is 70 in 3 years. I should be happy it's higher than today's price. But you see how minimal that standard is? To get from 50 to 70 in 3 years means I'm making, let's say, 11% a year or 15% a year. What do I have to then still ask? Is that a sufficient return? And to make that, I need a benchmark. All the CAPM is supplying is a benchmark that I compare the return you tell me you can make. And that is the only way I can decide whether something is cheap or expensive. Which actually brings me to Martin's point, which is if I'm the manager of the company now, you know what this 9.95%, you are what? Potential equity investors, right? And what are you telling me? You need to make 9.95%, not even to be happy, just to break even. This is my cost of equity. So next time you hear somebody say cost of equity, don't get lost in abstractions and models. This is what you're estimating your equity investors as needing you to make as a company to break even. So when I go look at projects and I look at the return on equity in a project, which is what I can generate from the project, what do I need to make sure that I do? Deliver more than 9.95%, right? But I'll tell you the weakest link in this number. 10 years ago, I was talking to the CFO of a very large Asian company. I will not name names here. And I'm sitting across the table from him, and he says, what do you think my cost of equity is? I said, it's about 11%. He said, it's not. I said, if you know it already, why the hell are you asking me? So what do you think it is? He said, it's only 1%. 1%. How do you get a cost of equity 1%? What do you think he was using as his cost of equity?
That risk-free.
He was actually using the dividend yield on his stock. So explain to him how you get from the 1 to the 11. What is the extra 10% I'm charging for? Because if you invest in a stock, so I told him, look, you can't just make enough money to cover your dividends. People don't buy stock just to collect. They want price appreciation. He said, what if I don't deliver it? You see what the next step is. Because if I borrow money at 8% and don't make the interest payments, what happens to me? I go bankrupt. But if I raise equity with a promise of 11% and I don't deliver that 10%, he said, what's going to happen to me? So tell him what's going to happen if he goes out and takes projects that make 1% and people are expecting 11%. The price will drop. He said, so? I said, you won't be able to raise as much equity. He said, I don't care. I'm a mature company. I'm not planning to go back to the market. It's getting deeper and deeper in here, right? So then I hit him with a final thing, which is if your stock price falls, your stockholders are going to be pissed off. He said, so? You're going to lose your job. He started laughing. He said, do you see the last name on my nameplate in front of me? Do you see the name of the company? Do you see their match? Now do you see why I spent as much time on corporate governance as I did? As corporate governance gets weaker and weaker and weaker, you know what managers start thinking about equity? It's free money. Yeah. And once you start thinking of it as free money, then the consequence of a 3% project looks great, right? Yesterday I actually computed what companies in different parts of the world are doing relative to their cost of capital. So basically the Chinese companies collectively last year generated a return on their projects that was 3.5% lower than the cost of capital. That is the lowest, that's the most negative number. In fact, I'll give you the rest. China is the worst, small Asia is the next. Brazil is not as bad as you'd think it is. There are other things happening there, right? But most of Asia looks awful. And I think this is, it might be pure coincidence, but Asian companies, I am amazed at how often, even if it's family run, especially maybe because it's family run, that if they raise equity from the market, especially the mature companies, how they think it's my equity now. The notion of stockholders being owners of the company is so foreign to these people that because this is based on the presumption that stockholders are part owners of the company. They have an expected return, you have an obligation to at least try to deliver that return. They're not even trying. So if you want this to be a cost of equity, unless you have the corporate governance, so don't be surprised if you go back to your company and they say our hurdle rate is 3% on projects. That's what it costs us. And you can do all the explaining you want about why it's not true, but if there's no heft behind what happens if you take bad projects, they're going to just put lip service to it. So just to complete the process before the break, let me show you the rest of the companies. I won't spend as much time, but I want to just hit the high points. I took Tata Motors. Ran a regression of returns in the stock against returns in the market index. The beta that I got was 1.83. So if I read that, it's 1.83 times more risky than the typical company in the market. It comes with a standard error of 0.16, which means there's a pretty big range around that beta. R squared is 69%. But that's using the Sensex as an index. I actually ran Tata Motors has an ADR, which is listed in New York, and you can run that regression against the S&P 500. You think you're going to get the same beta? You get 1.15 as your beta. So which one should you use? Whichever fits your story. That's a cynical answer, and that's what ends up happening. That's another reason why I think these regression betas are so incredibly dangerous. Is I've told people, you give me 30 minutes, you give me access to a Bloomberg, you tell me what beta you want, I'll deliver that beta on a printed page. Because I have enough discretion, starting point, ending point, different indices, I'll get there. Yep.
Sorry, Professor, for non-finance in this class, because for finance guys, these are very, very straightforward. For finance, we have two concepts. You are saying that they are very, very dangerous. Beta and R squared. So, can we say that this?
But back up. These are not finance. Statistical. You have problem with them statistically. You're having problem with them financially because those are both statistical concepts, right?
Yes.
Beta is a slope. R squared is a proportion, right?
Yes.
Yeah.
Yes. But exactly. So for us, these two concepts are two risk concepts, right? So
two estimation risk concepts.
Estimation risk.
Exactly.
Yeah.
Maybe that's a broader message I will give to you is don't trust somebody when they say the beta for the company is, because bankers will throw numbers at you. Beta is 1.31. They will act like it's a fact. And what I hope I've laid the foundation for over the last 25 minutes is it's an estimate.
Right.
That's an estimate based on the judgments you made in the time period you looked at.
And that R squared as well is an estimate.
They tie together because the R squared were 100%. The beta would be absolutely precise, right? So when we talk about betas being estimates, that goes with the fact that R squareds are going to be much lower than 100%, maybe 30% or 40%. So they're all connected together. This is an estimation process with a lot of noise. So when I give you a number, it's not because I'm trying to lie to you, but that number is actually coming with a range. So what you're pushing back against is this notion that just because you got a beta from a service or a regression, that somehow you know what the beta for a company is. So in this case, if you look at the go ahead.
Why do we need this beta range? What is the range needed for?
Well, because it's
is what you said we should use.
Well, you can plug the number in, but also why do you need the range? Because when I ask you what the cost of equity for your company for Disney is, you can say it's 9.95%, but your true cost of equity could be 8.55 or 11%. So let's say you deliver 10.25% of return on equity. You think you're beating them, but it might turn out that I just underestimated your beta. So it's good to know what the range is because you want to try to push outside the range, right? You want to make, so it's not even best case. I'd like you to make 11.5% return equity so you're not at the, caught up in this.
But
So
if the data is too high, the standard error, then it's like...
it's not in your control, right? It is what it is. So if I took the beta for Twitter, it's a huge standard error. Not because I don't want to make it more precise, but because the price has been all over the place. Right?
It's just to double check your...
It's exactly right. It's really to be honest with yourself. Because after a while when you use numbers,
So you want to beat the range, basically.
you want to beat the range, exactly.
Excuse me.
Yep.
Something on context.
Yep.
I don't want these people going home engaging with companies at this cost of things. I think that's true, like 10 or 15 years ago, but I think that's changed. I'm from Japan,
Right.
and I think that's really dependent on who your soft deposits are. And I think Japanese companies are changing primarily because the cost shareholding has been
Exactly.
Secondly, your shareholders are institutions, not from insurance companies and banks. It's because you have foreign institutions that are coming in. And thirdly, the cost of capital, yes, it's fair enough that there is this cost of capital, but also in Asia and also in Japan, the cost of borrowing is very cheap.
I don't disagree with that. I'll tell you why Japan has changed.
So I don't want them, to go home.
They, in a sense, Japanese companies are changing because they were at the vanguard of this bad capital allocation process, right? You go back to '86.
Yes.
This is what dug the hole that put them in the place that they ended up 10 years later. So part of this is they got the blowback of raising market capital, investing in projects that delivered less than their cost of equity, and then spending a decade trying to dig themselves out. So part of it is that they've had, I think also in Japan, the stranglehold of family-run companies has become much smaller. So you go to Korea, or you go to India, you look at the Samsung, or you look at Tata, or the Tata Group, there the family control of these companies is much, much greater. So you're right, maybe Japan in a sense is laying out the template for other Asian countries to follow. But I think it's far ahead of much of what you see in Southeast Asia and China. And China is awful. I mean, in terms of investing, it's all hope and prayer and promise and potential. And people are investing in things they shouldn't even be sniffing at, right? So you're right. Japan, I think, is starting to separate partly because the investor base, partly because managers learn from bad experiences that this country.
Other South Asian countries,
Right.
I mean, countries in China and what we
Right.
also see manifested in Korea will follow that trend.
We'll follow that trend, you hope. See, the reason is you have to survive, and my fear is some of these companies are going to have to fail for other companies to learn. And we're going to see in China, especially in the next 2 years, a lot of companies failing, not just because they got unlucky, but because they were making bad investments across time. So Tata Motors, my beta is 1.83. If I plug it into my expected return in rupees, my risk-free rate is 6.57%. Do you remember where that came from? I start with the government bond rate in rupees, 8.82. I did 2.25%. Remember you guys were freaking out when I did this? I removed that premium. Said, look, it's getting too low, it's getting too low. And I said, trust me, I'll come back and punish this company. The risk-free rate, so if this were a Greek company, my risk-free rate in euros would be 0.8%, right? It's the risk-free rate of the currency. The beta is going to reflect the risk of the company. The equity risk premium is where I bring in my punishment factor. So if you're a Greek company with all of your revenues in Greece, your risk-free rate is going to be low. Your beta is going to reflect the fact you're a hotel company. I can't push up the beta as well because the average beta has to be 1. So I can't play games with the beta. But my risk premium is going to be huge. So let me ask you a question. Can you visualize a Greek company with a low euro cost of equity? What type of Greek company? So basically it's got to be a Greek company where first you're doing things in euros. It's got to be in a low-risk business that gets almost all of its revenue. I was actually looking at a few Greek shipping companies. Okay? It's actually a very interesting place because when countries get punished, every company gets knocked down. And what I often look for are companies that I think don't deserve to be beaten up. So when I see Brazil melt down and I see Embraer go down by 50%, I've got to stop and ask, does that make sense? Now, Embraer to me is more like Boeing. If you look at Embraer and Boeing in terms of pie chart of revenues, it's very difficult. I know Embraer has its factories in Brazil. So that's, I think, why you want to start to separate the company from the country. Right? So,
how did you get 7.19?
I'm sorry?
Premium.
That's that came from 7.19 weighted average. So everything is connected to some previous page if you look far enough back. One final thing, the Jensen's alpha for Tata Motors was 35.42%. Often when you see a Jensen's alpha like that, the question you got to ask is, what did they do that entitled them to this Jensen's alpha? What did they do? Acquire Jaguar Land Rover. It's the best thing. I'm usually a cynic on acquisitions with one caveat. If you're going to buy something, buy it from somebody who's desperate to get rid of it at any price. Who did Tata Motors buy Jaguar Land Rover from? They bought it from Ford. Why did Ford unload Jaguar Land Rover? Because they were desperate in 2009. They wanted to get rid of it at any price. And they did. Tata Motors got the hugest bargain this side of whichever. And that's the 35.4%. Without Jaguar Land Rover, Tata Motors would have been sunk. Because their Indian business has not done well. The cheapest car in the world, Tata Nano, car so cheap that Indians wouldn't buy it. Everything was optional. Oh, you need a steering wheel? Why? Just put a bullock in front, let it pull your car. Didn't work. In fact, Tata internally in India has had a terrible 5 years. Jaguar Land Rover has been the ballast that's kept it up. So let's take a break. When we come back, we will...